When investors are choosing between mutual funds, they may look to past performance to help them decide. But our research shows that selecting a successful fund manager may be harder than it appears because strong past performance may not be a reliable indicator of future performance. In our annual study of the mutual fund landscape, we track more than 4,500 U.S.-based mutual funds invested in U.S. stocks, international stocks, and U.S. fixed income securities. This sample represents 48% of the U.S. mutual fund industry. These mutual funds manage about $6.6 trillion, or approximately 42% of the U.S. mutual fund market. Let's take a look at the data from our sample, which includes U.S. domiciled funds at the start of 5, 10, and 15-year periods through December of last year. We found that over the last 5 years, a quarter of equity funds did not survive, meaning they stopped operating sometime over this 5-year period. And about a third both survived and outperformed their benchmarks after subtracting fees and expenses. Over longer time horizons, the percentage of funds that survived and outperformed was smaller. We saw similar results for fixed income funds. Less than 20% survived and outperformed benchmarks, and the longer the sample period, the lower the rate of survival and outperformance. So you might look at these results and say, well, I'll just pick the winners. But our study indicates it might be difficult to identify these winners in advance. Let's turn back the clock 5 years and say I'm looking to invest in an equity mutual fund. To pick a fund, I'll consider investing in only those funds that have beat their benchmarks over the past 5 years, or about 30% of the equity funds we studied. Then we take those past winners and observe how they performed over the next 5 years. How many will continue to survive and beat their benchmarks? The data indicates about a third of those past winners continue to survive and outperform their benchmarks. Strong track records that persist were in the minority. We saw similar results for fixed income funds. Of the percentage of funds that survived and outperformed their benchmarks in the first 5 years, about a third of those continued to survive and outperform their benchmarks in the next 5-year period. This evidence suggests investors might consider looking beyond past performance when selecting a fund. So what else should they consider? Costs are important, and all mutual funds incur costs. Our study shows equity mutual funds with higher fees have a lower percentage of winners when compared to funds with lower fees. This shows that high costs may contribute to underperformance because the more costs a fund incurs, the higher its returns must be to outperform. It's important that investors understand how the fund is being managed. A fund's investment management approach can affect future performance as well as costs. At Dimensional, we believe stock and bond strategies can be designed and managed to outperform the market without having to outguess it.